Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby Kinzer,
And I am Thomas Doty.
and we are the FITT Show, helping our folks get their finances in shape, hoping that you learn more about the stock market, hoping you understand more about personal money management and creating generational wealth. Now, last week we talked about weathering the storm, how to deal with corrections and bear markets versus bull markets. But this week we're going to talk about why diversify, because diversification is a major component to managing your finances. So just want to remind everybody to please go out there on Facebook and click on the thumbs up button as many times as you can. Click on the heart button because that gives us traction and it exposes us to more people to watch. That's how Facebook works, the algorithms. Also, if you're on YouTube, please subscribe to our channel, The FITT Show, FITT, capital letters, The FITT Show. Dope. So what's been going on with the market, man?
Man, it's been a roller coaster. If you look at the week, the Dow went up from 33.9 last week to 35.1 this week, but it lost 500 today. And even with that 500 loss today, for the week it's up 3.5%. The NASDAQ, which also lost about 500 points, is up 4.5% over last week. It went from 13.3 last week to 13.9 today. A couple of my key holdings, Microsoft lost 12 points today. For the week, it's up 4 points, but rough day for Microsoft. Tesla, which has just been crazy, for the week, it's up 10%. It went from 810 to 891, and it only lost 15 points today. Apple is up 6% for the week. It went from 163 to 173. It lost 3 today. And finally, my Pfizer has been pretty flat over the week. Hasn't really done much. So this has been a crazy week, and this is going to, diversification, as we talk about that, is going to help you manage some of the craziness in the market, some of the ups and downs, the highs and lows, and we'll show you why diversification can help you make out in these crazy markets. How's crypto done this week, Bob?
Man, crypto is still taking the beating. It'll go up on 1 hour, like say 4%, and then within like 3-4 hours, it goes down the same amount of percent, 4 more%. It's been just a crazy market right now with the cryptocurrency. Don't understand what's going on. Last week the Bitcoin was at $37,167. This week is at $37,216. So I mean, it's doing a little bit better, but it was doing better than that. I think it got up to like $38,000. But the cryptocurrency market has been taking a beating. But like me and Doty always talk about, we say there's two ways to play the cryptocurrency game. That's the long play where you just get in there and hold it and don't worry about it. And then there's the short play where you're jumping in and out, and it's hard to time the market like that. But you can make money in cryptocurrency if you ride the wave and get out. But if you're into it, we always say, make sure you only put in money that you can afford to lose. And also have an entry strategy, but you need to have an exit strategy as well, because cryptocurrency is changing on so many different platforms. And all the platforms doesn't exchange it into what they call fiat currency, which is the dollar. And you need to understand that. But you need to have an exit strategy so you know how to get your money out, and don't be greedy. But that's what's happening with the crypto market. But it's
Hey, Bob, and don't forget, cryptocurrency transactions are taxable events. So if you sold crypto last year, sold it, bought it, sold it, or bought it and used it to pay for something, that's a taxable event. And the IRS will be looking for you to show that on your 2021 tax form. So make sure you are aware of that and discuss that with your financial professional, your tax professional.
And like we say, cryptocurrency is highly speculative, and that's okay if you're a person that can take that kind of risk. but you must understand. We always talk about don't be in any investment that you don't understand. And a lot of people are in the cryptocurrency don't even understand. They're just going by what people told them. I don't care if it's cryptocurrency, the stock market. You must understand which you are dealing with investment. You're dealing with anything, and like we also say, seek some professional advice too. But so dope. The Bitcoin, which is usually the most stable one that a lot of people, is still number one out of the 14,000 cryptocurrencies. So, but Shiba has dropped it down out of the 13th place to number 14. And a lot of people was investing in the Shiba when it came on. It's like a meme, like a dog type thing. So anyway, that's what's happening with the marks, you all. And that's why we're going to be talking today about diversification. So, dope, why don't we just jump right into it, man? Why diversify?
Yeah, and again, the reason you want a diversified portfolio is because it's going to help you ride out these corrections, these ups, these downs that are bound to happen. I think one of our takeaways last week was it's not when or if it's not if the market's going to correct, it's when, because it's not going to just go up, go up, go up. So just make sure you're aware of that. So what diversification can do, it can help you manage the risk, that risk of the market going down. It can make you avoid, you can avoid costly mistakes by adopting a risk level that you can live with, something that you're comfortable with. And then you rebalance. And that's how you maintain that risk level as things change. As one investment may go up, one investment may go down. If you need to rebalance to keep your risk level at an acceptable place.
And that's very important to understand that. And the goal of diversification, which a lot of people confuse, is not necessarily to boost your performance. It won't ensure gains or guarantee against losses. Diversification does, however, have the potential to improve returns for whatever level of risk you choose to target. For instance, last week we talked about volatility and market corrections, bear markets versus bull markets. If anything, we want you to take away is corrections are going to happen. Diversification is one of the main tools to mitigate against these volatilities, against these volatile moments. And that's why you need to consider diversification, not just to boost the performance, but to have a balance, to ensure against, to mitigate these really changing markets. Because just like those say, they're not going to always go up, 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 up. But you know what? They're not going to always go down, down, down. But diversification is very key.
Okay, and let's jump into how to build a diversified portfolio. And so you got all these things out here. You got stocks, you got bonds, you got cash, you got crypto, you got all kind of different investments. The returns on those investments historically don't always move in the same direction or to the same degree. Different things may make something go up more than something else. And so if you can get a mix of those, even if one particular part of your portfolio is declining, the rest might be going up, or it just might not go down as much. So you're trying to balance what you have so everything isn't moving in the same direction, because you have to have that give and take, where if one particular investment is going up, for example, stocks, then the bonds may be going down. And that's okay. You don't want to have all your money in stocks at that time because, again, the risk level. So you spread your portfolio over the different types of investments that are available.
So another aspect of building a portfolio is trying to stay diversified within each type of investment. For example, you may not want one stock to be 5% of your portfolio. Diversify across, you want to diversify across stocks by market capitalization. And what I mean by that is the small caps, mid caps, and large caps. And then there's sectors, and then there's geographic, meaning regional type of stocks from a particular region. but small cap is usually 500 million, I think, or less. Medium is above that 500 million to probably a billion, and a billion or more is considered large caps. Remember, the largest, and all of this is telling you the size of the markets that you're dealing with, and not all caps, not all small, mid, and large caps, not all sectors, and not all regions have prospered at the same time or to the same degree. So you may be you may want to reduce your risk by spreading your assets across different parts of the stock market.
And you can also consider a mix of stocks, such as growth stocks and value stocks. You think of growth stocks, you think of more of the tech type of stocks. The growth stock, you think of more tech types of stock, or smaller companies, or maybe even mid cap. Then you think of value stocks, that might be your old tried and true stocks. That's just another way to spread your risk by looking at different mix within even your particular stocks. And so if you look at bonds, that's a little trickier as far as getting a diverse mix in bonds. You can look at different maturities. You don't want to have everything maturing at the same time. You can look at different credit qualities. You can buy some bonds that are grade A, and you can buy which are going to probably pay a little lower interest rate, versus bonds that are a little riskier and may have more credit issues. So again, you're spreading your risk within that one particular component of your investments. And you also may look at different durations, and that measures how the bonds react to interest rate changes. And so you got those three things. Again, if you have all your eggs in one basket, if something bad happens in that market, you pretty much lose everything there. But if you spread it out amongst different components within that investment class, you're going to be spreading your risk and reducing your chances of taking a huge loss when something bad happens.
And also, we like to reiterate some things that we always talk about before, and you need to understand the inverted relationship between interest rates, bonds and stocks. It's like when stocks are up, bonds prices are down. When stocks are down, bond prices are up. So that's why you want to diversify and have a bit of both in your portfolio, so that when one is doing better than the other, you make that gain. And if you switch over to the other particular investment, you can gain on the one that may be like bonds are considered a medium risk or less risk. There's still a risk than stocks. But when the stocks are down, bonds could be up, and you can be making, you can be actually getting the benefit from that particular diversification. So let's talk a little bit about diversification, because it's been proven it's a long-term value. Now, during 2008, 2009 bear market, if some of y'all can remember that, because I'm sure that was a housing market bubble when a lot of people took a hit. Many different types of investment lost value at the same time, but diversification still helped contain overall portfolio losses. And that's the key. Can't nobody predict the market. We always say that. But the name of the game is have a balanced portfolio so that you can withstand any future shocks from things happening in the world that affects the stock market. Now, also you need to consider the three types of portfolios. You got number one, which is diversified portfolio, right? With about 70% stocks and 25% bonds and maybe 5% cash, just as an example, or all stock portfolio. And remember how we always say this, you all. Your investment choice selection should be based on your personal risk tolerance, the level of risk that you definitely are willing to take. And then the number three example is all cash portfolio. And as you can see, each one of them have different risk levels. And you know, if you're in an all cash portfolio, your risk level is very low. So you're going to be safe. But the only problem is your risk and the reward is not going to be the same. And that's why it's so important to, have your portfolio well balanced. Dope, I want to take a minute, man, and say hello to people that are out there watching, wonderful, the consistent viewers and the new viewers, like Jennifer Bing. Love you, Aunt Jen. Glad you're out there checking us out. My homeboy from DC, Melvin Little, and Carlos Perez, Texas A&I University's finest, where I went in 1977 to 79. Go Javelinas. And I'd like to say hello to Charles Green. Oh man, oh Kitty, and my wonderful friend who was one of the best public speakers you ever meet. She was one of the lead of the Toastmasters at the FDIC, still there. And Kitty said she lost a lot of money the last 3 weeks, so that means she probably was in the growth stocks, probably. Not sure.
Yeah, but that's the thing. When you say you lost a lot of money in the last three weeks, had you not been invested, had you been invested the whole time, you'd be so far up that you would have just lost some of your gain. So you lost money, but I would venture to say she's probably up overall, which is the goal. You don't worry about the short-term ups and downs. The goal is to invest for the long term, build wealth long term. That's always been our thinking. That's all we've ever talked about, was building for the long term. You're going to have huge gains, some losses, but over the long term, being invested in the market smartly, you're going to make money.
And this is the other thing, Dope, about people who are experiencing losses this past few weeks in the stock market. Unless you took that money out and cashed it out, you have not realized the loss yet.
There you go.
Okay, so don't forget that. And secondly, like you said, Dope, I guarantee you, if she had that big kind of loss when the market was really doing well, she made probably way more than that in gains. But
hey, Bob, this is the perfect segue into our next subject, and it's the psychology of investing, and what happens, and it's why risk is important. Why you have to understand this whole risk thing. Many investors struggle to realize the benefit of their investment strategy. And by that, I mean, when times are good, everybody wants to buy stock, and when the market's rolling, everybody's buying stock. Everybody's buying stock, and they're in riskier investments. But in down markets, when the markets start going down, everybody gets nervous and starts selling, okay? So if you take a step back and look at that, as the market's going up, when the market's high, you're buying. When the market's going down, when it's low, you're selling. That just does not make sense. And that's why we've been talking about, since we started our show, we've been talking about consistently investing, so you get away from that buying when it's high, selling when it's low, and you're buying consistently. You're buying constantly and consistently. And we've always talked about dollar cost averaging. When the market's high, you're buying less shares. When the market's low, you're buying more shares. And you get out of that panic of selling when it's low and that euphoria of buying when it's high, because you're just buying consistently. And that's the way you make wealth. It's if you talk to any of the Warren Buffett or Peter Lynch, the gurus of investing, you talk to anybody who's made money in the stock market, they will all complain about the stock they sold. Okay? They'll think about a stock they bought and they sold too early. Okay? And again, we think if you think long term, get a steady plan, that's the way you make money. Okay? Not reacting to what's going on in the market. And if you look at the results of most people, the degree of underperformance by individual investors has been the worst in bear markets because they're panicking and selling, or they're doing something Bob just mentioned a minute ago. They're investing money that they're going to need in the short term, and they have to sell. So we've constantly preached, do not invest money or do not have money invested that you're going to need in the next 3 years. And 3 is just a benchmark. But you don't want to have money invested that you're going to need because you may be forced to sell at a loss. So you invest money that you can have in for the long term. I mean, being disciplined as an investor, it isn't easy. But over time, if you are disciplined, it's demonstrated the ability to generate wealth. And market timing has proven to be ineffective even for professionals. Professionals can't time the market. So we continue to preach constantly, consistently, investing good quality stocks. That's the way to do it.
Hey,
That's the
Dope,
way to do it.
correction I want to get when I talked about Kitty, she said this was she was talking about 2008. She lost about a bunch of money. And I
Everybody
did
did.
too. My thrift savings plan, because I was with the FDIC, we had quasi government, so we had two 401ks plan. I lost 40,000. Well, excuse me, my portfolio went down 40,000, but I didn't panic. I stayed in, didn't panic, and dope. It came back in about maybe two years at the most, and it came back double the 40,000.
I mean, I get nervous even thinking about that time because I had my 2 kids were in private school and my other 2 kids were in college. So it seemed like all I did was work and write checks. And so when the market went down, it was traumatic. But fortunately, I can honestly say I did have it set up where I didn't have money I needed invested in the market. That's what we keep preaching. If our principles have proven to work for us, and any investment book you'll read will tell you the same thing about understanding your risk level and being invested over the long term. You'll do well and build wealth.
Dope. And excuse me, because I'm working the back office and everything. Did you actually talk about why risk level is important? I know you kind of touched on it, but did you want to talk a little bit more about that?
Yeah, we touched on it because we want to get you away from panicking. Okay, we want to get you away from looking at reacting to the market and making decisions based on the market. You set your risk level when you build your portfolio. Okay, you set your risk level of how much you can live with, how much risk you can take, or you can help you sleep at night. Bob and I always have this discussion. He's much more risk averse than I am. He on a scale of 1 to 10, I'm probably, if 10 is being 100% in the market, I'm probably 60, 70%. And I think Bob is probably, you might be more 40 to 50%.
More 40 to 30.
Okay, so he's much more risk averse than I am, and that's good. Everybody's risk level is not going to be the same, and there's not a good or bad. So make sure you understand that, and you might be in a position to be more risky if it's not money you're going to need in the future. If it's not, and you feel you have good solid investments, and you are diversified. You can be more risky the more diversified you are also. So make sure you understand that the more you have diversity, because everything typically, I mean, obviously anything could happen, but everything typically does not go down at the same time. In the markets we've gone through the last couple of weeks, I can't tell you specifically, but I can guarantee you there's some segment in the market that did not do as bad as, say, the tech sector did. So if you're heavily invested in tech, then you're probably suffered a bigger loss than someone who's heavily invested in value stocks. But again, if you have diversity, if you have some of each, and we talk about diversity, there's so many levels of it. And if you, for example, we didn't mention geographic diversity, having some money invested in the US market, but also having money invested in the mature markets in Europe, and even in some of the emerging markets in China and South America. You put money a little bit in each of those, they will probably not all move at the same time. So the more diverse you are, it's probably you can be a little more risky because everything's not going to go bad at the same time.
Now, though history of go ahead. I mean to cut you off. Go ahead.
No, I just said me personally, I don't have a lot of money in emerging markets. I'm a little bit afraid. I'm a little afraid of like China and Brazil, but I do have money invested in international, in some of the mature markets in Europe, because again, their cycle is going to be different than what's going on in the U.S. So if the U.S. does slow down, the European markets will probably pick up, and again, that's spreading my risk out.
And though history has shown that most people's underperformance happen during bear markets, because people tend to panic when the stocks are going down. And that's those strategies, that's when you need to be getting in, because now the stocks are cheaper. Another diversification tool that a lot of people don't use, because Kitty even said in her comments that she must admit in the early 2000s she was way more at more risk, taking more risks in the stocks or in growth stocks than anything. That's why she took a beating in some particular times in the market. But right now, though, I bonds, they're paying 7.12%, 7.12%. Because interest rates have got to go down. I mean, right, and bond prices go up, and I mean, it's holding until April. It's quarterly, if I'm right. That rate holds for every 6 months or 3 months. 3 months.
I think it's 6. I think it's 6 months.
It's right, 6 months. That holds, and you'll get that. But bonds are considered more safer. They're backed by the full faith and credit of the United States government. They're not giving you the return like the stock market has been over time, giving like 15, 20, 25%. But you're getting a good steady 7.12%. And that's daggone more than you get in a CD. And we know it's more than you get in a savings account. And it's estate tax free. You can get a tax advantage. So these are the things that you need to be looking at when we talk about diversification. Because a lot of people, though, are in the thrift savings plan, and they have the C fund, which is stocks and growth stocks, and the F is bonds, and the G and the S and I. And most people don't even know what those funds goals are, and they need to be aligned with what your goals and your risk is.
And we've talked about if you're looking for some get rich quick, that's not what we talk about. We're not saying anything's wrong with that. If you can find something and get rich quick, hey, more power to you. And I think Bob mentioned earlier in this talk that we're not saying you're going to make 20%. Even when we talk about the 9% that the market makes, we say on average the market makes 9%. Now, if you really look at that, if the market's making 9% and I'm at a 70% risk level, that means I'm only 70% invested in stocks. I got 30% in other things. So I'm not making 9% on average because I'm not 100% invested in stocks. So we're not looking to get rich quick. We're looking for a steady stream of making money that's in a diversified portfolio that protects us against big drops or big corrections in the market. And make sure you understand what I'm saying. When we say the stock market, that's being 100% invested in the market, or the S&P 500, for example. If that averages 9% a year. I don't want you to think that, oh, yeah, Dodie and Bob are saying if you invest in the market, you'll make 9% a year. You'll make 9% on average if you're 100% invested in the stock market. I would not recommend that for anybody because that's extremely risky.
Dope.
So, yeah.
Sorry. Another, I want to talk about, because we talk about diversification, right? And I talked
Yep.
about bonds as a part of your diversification. But can you take a moment to explain to some of my friends that were asking about the diversification instrument of index funds? Can you explain that a little bit?
Yeah, index funds are, it's so funny because it's really crazy that there's like 2,400 stocks and there's like 2,500 index funds. So there's a gazillion index funds out there. And the reason you do an index fund is to have a diverse holding, a diverse holding. But some of the index funds out there are so specific, like there's a natural gas index fund. That's really not a diverse investment. When I think of diversity, I think of an index fund that represents the S&P 500, or maybe an index fund that represents small cap or mid caps or large caps. Now that's where you're getting some diversity. When you're getting some of these very, very narrow index funds, you're not getting any diversity. And that's the key thing about an index fund, is to get you diversity. So I would tend to look at an S&P 500 index fund. Another advantage of index fund that's from a tax perspective, if you have a mutual fund, and this is something, I hope I'm not getting too accounting crazy for you, but if you have a mutual fund, they buy and sell stocks during the year, they get dividends. Well, mutual funds are required to pass those gains and losses on stocks and pass those dividends on to shareholders. So every year, a mutual fund is going to have a capital gains distribution. That's a taxable event. I have a mutual fund called Fidelity Equity Income, and it distributed $1,800, I think, in November. Now that's a taxable item that I have to put on my taxes. It's reinvested in the mutual fund, so I don't really get any money. I didn't buy or sell the mutual fund, but I had a taxable event. An index fund doesn't have that same requirement. So you don't have a taxable event until you sell that index fund. So to me, that's an advantage of an index fund over a mutual fund, is that you don't have that taxable event until you sell. But they're very similar, and we said this before, except an index fund is traded like a stock. So you can buy and sell it during the day. A mutual fund, that transaction only takes place at the end of the day, when the asset values of all the stocks that make up that mutual fund are calculated, and then you get a price. So if you put in an order to buy a mutual fund, the transaction won't take place till the end of the day when the value for that mutual fund is finally determined. An index fund, handled totally different. It's like a stock. It's bought and sold throughout the day. You put in an order to buy an index fund, boom, you have it right there. But if you're going to get a mutual fund, make sure it's diverse. Make sure it's spreads your risk across several different either sectors or technologies or regions or types of stock, growth, value. So that's why you should be in a mutual fund or an index fund. And I personally prefer index funds.
Great. Thanks, Dope, for sharing, because a lot of people had questions about that. So, Dope, let's take this home, man, and let's recap and give the summary and takeaways for today. So, number one, create a tailored investment plan and invest at the appropriate risk. That's so important.
Yeah, you have to figure out what your risk level is. Once you've chosen an asset mix, research, select appropriate investments that meet that risk level.
Then, third, you must manage your plan, and that means monitor it, rebalance, and refresh it. Monitoring, simply paying attention, tracking it, looking at it, rebalancing. Like we said, you could have a mix of 70% stocks and 20% bonds. You might want to rebalance it and change the balance of bonds versus stocks or cash. And then the refresh, you might have to take a new start.
Achieving your long-term goals requires balancing risk and reward. We always talk about not being greedy and being able to sleep at night. So again, my risk level much higher than Bob's. My reward level should be higher. Bob's risk level is lower than mine. His reward level is lower, but he probably sleeps a little better at night than I do. So you have to balance that and make sure it's what you're comfortable with. Make sure you're comfortable with that risk level that you set.
And we can't say this enough, but we want to close with this. Choosing the right mix of investments and then periodically balancing and monitoring your choices can make a big difference in your outcome. These are all important tips, you all. Diversification is the way to go. I know a lot of people don't always ask me, Bob, why are you and Dope pushing the stock market? Because we just don't have too many options, to our disposal. And, the stock market is one. Granted, we know it's not for everybody, but it is for everybody because if you in and you play the long play, the market has always corrected and has always turned. And if you want to increase your wealth and you want to create generational wealth, or you just want to create wealth that you can be charitable and help other people, understanding the stock market is one of the ways to go. In order to get paid, you got to play. You got to play to pay. That's as simple as that.
And Bob, we always say none of us would ever be 100% invested in the stock market. I'm not sure you'll find many people who are 100% invested in the stock market. But you have to, if you want to make some money, that's one of the great places to do that. And there are obviously other places. There's gold, there's crypto, there's real estate. It's not the only way to do it, but we found it to be the most consistent, steady, and I don't want to say easy, but doesn't take a lot of effort if you have money in a mutual fund or an index fund to make money over the long haul. It's done me extremely well, and it works. And people have made a lot of money doing this for a long time. But as we talked about, the discipline is so important to not be buying and selling like you know what's going on, because you probably don't. I read and watch shows, and I think I know a little bit, but I still would never try to time the market. I just know enough to know I don't have that knowledge.
And this is why me and Dope are so on to managing your money so that you get the most out of your money. We know everybody's not, high risk takers and things like that, but the name of the game is you want your money to work for you, because you got to be careful because inflation is taking off. It went from 2% to 7%. It was going for 2% for the last, 10 years. But now it jumped up to 7%, the highest in maybe 40 years. And that directly starts affecting the cost of products. So if you think you got, a nice little savings and a savings account that's earning less than 1%, and now the cost of goods have gone up by 7%, it'll eat through your savings. And that's why you need to look forward for the years to come, because you're living longer and you want to keep pace or outpace inflation. And you also need to be concerned about taxes. You want to be able to have your portfolio to outperform taxes and inflation. And that's how you build wealth. There's a many different ways. Me and Dope's not saying there's not other ways, but this is just the way that we're talking about, because we want to see all the boats rise, all the ships rise. And it's simple. It's about being disciplined. It's about having a plan. It's about understanding your risk tolerance and just being in the game. So anyway, Dope.
Hey, Bob, one more thing. If everybody, especially folks who are close to our age, I'm sure you can all think back of a stock that was recommended to you at some point in your life, at some point 20 years ago. Now, just think if you'd have bought 100 shares of that stock, and I don't care what it is. If it was Disney, if it was Microsoft, if it was Apple, if it was Intel, you name any of them. Go back and look at how much money you'd have made had you bought that stock and just held on to it, or had you bought an index fund and just took that investment, let it sit for 20 years at 9%. Okay, that's probably, that money would have doubled 2.5 times in that time period. Okay, it would have doubled 2.5 times in that 20-year period if you're averaging 9%. And that's something we didn't learn sitting at the dinner table. That wasn't discussed in my house. Maybe it was in yours, Bob. That was not discussed in my house as far as buying stock. And that's what we're trying to get people into the habit of getting in the stock market, understanding what you're investing in. And if you don't want to understand, then just buy an index fund. Don't buy an index fund with all your money. Okay? Find your risk level. Put how much money you can afford to put in there that you don't need, and watch it grow.
So you want to talk about my household? The biggest investment in my household was the insurance policy, where this man would come by and collect $5 for a whole life policy. And that was for like a $5,000 death benefit policy, because the mother just wanted to make sure somebody got buried. That was the biggest investment in my household. So anyway, before we go.
Well, but just real quick, that always amazed me, because that was the only white dude that would come by our house. You know, that was always kind of strange to me. He'd come by to collect that little bit of money every week.
The premium, man. But look, black folks made sure they had that death benefit. So, Dope, before we go, I want to holler out to my wonderful good friend, Robin Roberts. Hey, Robin, hope Greg is doing fine. Michael DeBose, going back. Emory Playground's finest. And Bruce Chase, Dope, is on. Bruce, Penn State finest, baby.
And my first roommate.
And my wonderful sister, Linda Kinzer Sy. Thank you all for tuning in. Dope, is there anything else you want to talk about before we go out?
No, I think we beat their ears enough today.
Yes. So thank everybody for staying on. We are here every Thursday. This is our 36th show. Every Thursday from 8 p.m. until this particular time. Normally it's about 40, 50 minutes that we go at the most. We don't want to wear you out because we know you got so many things to do. But please share this on Facebook with other people, and also subscribe on YouTube and tell people about this, you all. You can go out there on our Facebook site, the FITT Show, and we have shows that are archives. We've covered the gamut, taxes to estate planning, to burials, funeral plans, to credit cards and credit scores. And look, we just getting started. There's so many more topics that we need to know about, and we want to that you need to know about. And we too, make sure you go down in our comment box and put in any suggestions that you have, any topics you want to talk about, any things that you're dealing with. But just remember this one little thing. We are not financial advisors. We are financial educators.
And Bob, if anybody has any hints or things that work for them, please share us, because that's what we're about. We're about sharing information. We aren't, I think we said this 100 times, but we aren't trying to sell anything. We have no ulterior motive. We're just trying to pass on some knowledge that we've picked up over the years and share some of the successes we've had and pass it on to other people. So if you have some things that work for you, please let us know, and we'll share those with our people too.
Put them in the comment box. So thank you all. And wonderful Garnett, always dope. She told us, great show again. Thank you,
I got to
Garnett.
meet her when I'm coming to DC.
We take
She's
you.
been here the whole time.
Let's take her to dinner, though.
Okay, that's a bet.
Garnett Nichols, we taking you to dinner with Motor Steam, by the way. But thank you all for tuning in. Have a great rest of the week. And remember, no risk it, no biscuit. Y'all have a good evening. And the FITT Show, 8 p.m. every Thursday.